Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. An analyst at JP Morgan recently said this commodity is poised to be the #1 performer this year, even better than gold. That would mean a giant rebound, considering gold touching new highs is up 23% this year, while the price of natural gas closed Friday down 24% for the year. Finishing as the year's top performer would mean a very strong 40% plus jump, so I'm digging in for the details and to show you the stocks that could win, along with updates to shares of Target and a warning that investors are working harder, not smarter right now. But first, if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by investors and for investors. I just started using it last year and love it for getting the ideas and sharing my own portfolio. This isn't just another social investing app. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 150,000 investors in the social feed to see what everyone is talking about. I've shared my portfolio on the app and it's totally free to download, so look for the link I'll leave in the description or just click the QR code here and check it out. Back to our main topic, an analyst at JP Morgan, Natasha Kaneva, wrote in an update recently that natural gas is poised to be the #1 performer among commodities this year, even ahead of gold. On a record high gold price this year and that natural gas that has slumped, it would mean a 40% plus rebound in the price of natural gas, so I had to dig a little deeper into this. To understand that a mild winter and a record oil production helped build storage and natural gas inventories 40% higher than the 5-year average, causing the price to crash 39% in just the 4 months to March. Since drilling for oil produces a side effect production of gas, record oil production in the United States has driven a lot of this supply glut. Prices rebounded briefly in the summer on just super hot weather across the U.S. with the idea that cranked up AC would take out those inventories, but cooler temperatures over the last month really destroyed those hopes and the price. Gas closed Friday down 33% from its June rebound and well off it from a year ago. So a snapback to become the top performing commodity this year would require a huge move. Gas companies have announced some curtailments which have helped bring that storage down to just over 10% above the 5-year average, but we need to see a lot more for the price to rebound. Chesapeake Energy and Coterra Energy announced production cuts over the last 2 weeks after EQT announced its own plans to cut another 90 billion cubic feet of gas production this fall. But there is another side to this picture apart from supply that could increase demand significantly. It's why analysts at Goldman Sachs are also betting on natural gas prices, saying driven by AI, broader demand, and a deceleration in the pace of energy efficiency gains will create a boom in new power generation that will be run on 60% natural gas, could actually move the U.S. to a deficit. And it's all tied to the boom in data centers and electricity demand on artificial intelligence. Training a large language model like GPT is estimated to use just under 1,300 megawatt hours of electricity. It's about as much as used by 130 homes for the entire year. And that may be nothing compared to using those AI models. One estimate is for the AI sector alone to consume between 85 to 134 terawatt hours by 2027. Now put your head around that. 1 terawatt is a million megawatts, so even the low-end estimate here of 85 terawatts would be the equivalent of adding 8.5 million houses to electricity demand. And we can see here in this chart, U.S. power demand growth has been basically flat over the last 10 years, but is expected to jump to a 2% annual growth from this year. That might not seem like much, but 2% of 4,000 terawatt hours a year is a big increase, and Goldman expects 60% of that is going to have to come from natural gas. Now, against the JP Morgan call for gas to be the top performing commodity, I do like the investment and the related stocks, but I think it could take a little bit longer. Futures pricing does show gas rising 61% through January's seasonal peak, but we still have to work through a lot of that inventory, and another moderate winter could hit prices. Building out power generation is also a notoriously long process with government approvals and regulations, so those AI data center booms is likely to drive demand growth, but it's going to take years rather than months. The direct investment here would be the U.S. Natural Gas Fund, ticker UNG, which uses futures and other derivatives to track the price of natural gas. Another option would be the ProShares Ultra Natural Gas, ticker BOIL, which also uses derivatives, but to amplify the changes in the price of nat gas by 2x. So for example, when gas and UNG dropped 3.6% last Friday, the BOIL dropped by double that, or 7.2%. but should also jump by 2x if natural gas rises. Now, understand the Ultra Fund isn't a good long-term investment, and it will miss out on that 2x return on expenses and trading costs over the longer periods. And if we're expecting nat gas to take longer to really recover, I like the producers better so I can collect that dividend while I wait. One of my favorite energy stocks here is Kinder Morgan, ticker KMI. It's a great play here and offers a 5.4% dividend yield. The company owns the largest natural gas pipeline network in the U.S., along with assets in storage and processing. KMI is gas-focused with 64% of cash flows and collects fees on the amount of gas through its network, so it isn't really totally dependent on prices going up. A more direct play on prices and producers would be EQT Corporation, ticker EQT. The 2% dividend isn't much, but this is the U.S. natural gas producer with 6.3 billion cubic feet a day of production and a $35 billion enterprise value. The company's assets in the Appalachian Basin help make it the lowest cost producer with higher production per rig, meaning it can wait out those lower prices longer than its peers. Another producer with a slightly higher 3% dividend is Chesapeake Energy, ticker CHK, which has assets across the largest basins in Eagle Ford, Haynesville, and the Marcellus. It's quite a bit smaller at $10 billion market cap and producing 2.75 billion cubic feet per day of gas, but also has the financial flexibility to adapt to prices and just survive until the rebound. And besides the producers, the midstream operators like Kinder Morgan and the natural gas ETFs, I'd also watch those unregulated power producers that could benefit from the increased demand on electricity utilities, including Vistra Corporation, ticker VST, Talon Energy, ticker TLN, and NRG Energy, ticker NRG. Looking at the stocks I'm watching this week, first up, Medtronic, ticker MDT. The medical device maker reports earnings Tuesday with low expectations built into the stock and maybe a rebound opportunity. Shares have shaken off that GLP-1 drug sell-off from the last year, but are still suffering from a slowdown in diabetes devices. The stock trades relatively cheaply here at 15 times this year's expected earnings, along with a 3.3% dividend. The company recently partnered with another device maker, Abbott Labs, to integrate Medtronic's automated insulin system with Abbott's glucose monitoring tech in a move that could help it compete with peers like Dexcom. Target, ticker TGT, reports Wednesday after jumping 3.6% when Walmart reported its blowout earnings last Friday. This year's expected revenue growth of just a negative 0.6% and 4% earnings growth are a low bar to meet, but I wonder if shares have already reflected that good news report, which could set investors up for a disappointment. Shares do trade relatively cheaply here at 15.8 times earnings versus 38 times PE from Walmart, so the sell-off shouldn't be too bad starting from that low valuation, but I'm just staying out of the way here. Also, Alibaba Group, ticker BABA, jumped last week despite a disappointing earnings report, but as earnings from other Chinese companies showed the economy is slowly rebounding. I'm up over $65,000 in 3 accounts on Alibaba and believe it still has some strong support at least over the next month or two. The company is likely to get its primary listing on the Hong Kong Exchange next month, which will open it up for investment from mainland Chinese investors in what could be as much as $20 billion in inflows into the shares. Besides that cheap valuation and 8% revenue growth this year, I think this is why we see a lot of hedge funds like Michael Burry and David Tepper buying up the stock in anticipation of that stock running higher heading into that dual listing. Burry increased his position to $11.2 million last quarter, by far his largest holding, and while Tepper's Appaloosa fund cut its exposure a little, Alibaba remains its largest holding as well. Now, I am worried that this could be a sell the news scenario, though the shares should be supported for at least the next month or two ahead of that dual listing, but we could see a sell-off afterwards as these hedge funds take their profits. Showing you the bigger picture here with the SectorSpiders.com sector tracker, all 11 stock sectors did close higher last week, with the previous week's losers, tech and consumer discretionary, really rebounding the strongest. The market has felt like that kind of a rubber band over the last few weeks, selling off and then bounding higher when that tension breaks. And with last week's proof of lower inflation, but also retail sales that showed a weakening but healthy economy, I think that tension may have been let out at least until the Fed meeting. Investors know the Fed is going to start cutting its rates, but also that the economy isn't just falling apart, a kind of a Goldilocks scenario for stocks. Now, if that is the case, that the markets face a good month of lower uncertainty until the Fed's September 18th meeting, then the bull market's favored sectors still have room to rebound from last month's sell-off. Tech stocks are still down over 5%, and consumer discretionary is down almost 6% over the last month. Within discretionary specifically, we see cruise and other travel stocks are down considerably, along with the automakers. Now, what could be a warning for some investors? I was worried last week that Walmart's earnings and weak retail sales reports could point to a slowing consumer, putting that last nail in the economy's coffin. Then both of those came out surprisingly strong, and it's clear consumers are not in trouble at this point. I know that conflicts with what you hear from politicians and the doom and gloom media, but look at the facts here, folks. Comp store sales at Walmart increased 4.2% in the second quarter, reversing a half-year slide, and the company blew past earnings and revenue estimates, with CFO Rainey noting that the company sees no fraying of consumer health. Then July retail sales showed a big 1% increase from last year, well above the 0.2% increase expected. Much of that strength was due to an uptick in auto sales, but even without automotive, retail sales were up 0.4% last month. Initial jobless claims reported Thursday also beat expectations for the lowest layoffs data since early July. None of this changes the Fed's course to start cutting rates at its September 18th meeting, but it does change the outlook on the size of the cut. Before the data, the CME Fed Watch tool showed market odds at 49% for a quarter-point cut and 51% odds for a 0.5% cut. Now, after that data last week, the market is pricing in 76% odds of just a quarter of a point cut, with some still holding out for the larger cut. And nation, here we get to the warning. I think it could be a warning for investors thinking that lower treasury rates or those Fed cuts and investments like the TMF are a sure thing. You only need to look at the 10-year treasury, down from almost 4.7% in April, now at 3.9%, to see that the rates have priced in some of that Fed cut scenario. Yes, lower rates will help the economy and support stocks over the next year plus, but it's not a guarantee that funds like the TLT or the 3X TMF will produce giant returns investors are hoping to get. In fact, if the Fed remains hawkish and only gives us a quarter-point cut in September, we could see those funds lose money on a disappointment sell-off. It proves that these kinds of short-term investing strategies are much more about expectations and investor sentiment than what should happen, and investors need to understand that before following others into those stocks. See all the stocks in my portfolio and join more than 150,000 investors on the Blossom social network. See what everyone is talking about with the invite link in the description, or click on the video to the right for the 7 highest paying monthly dividend stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.